All right, I've been watching LEEF Brands for a while now, and I want to talk about their Q4 and full year numbers because this is genuinely one of the clearest before and after stories I've seen from a microcap in a long time. The CFO on today's earnings call described 2025 as a tale of two halves, and honestly, that was exactly right. You can think of it like a restaurant that has spent the first half of the year buying ingredients at full price from a grocery store. Then mid-year, they open their own farm. Same kitchen, completely different economics. That's LEEF. So in the first half of 2025, LEEF generated 18.1 million in revenue, but gross margin sat at just 19.7%. Operating cash flow was negative. The business was running on a cost structure, but that, by their own admission, did not work and wasn't sustainable. So they knew it. They did something about it. And that something was Salisbury Canyon Ranch. It's their own cultivation operation in Santa Barbara County, 65 acres, close to 2 million plants. And most importantly, they're growing the same material that they were buying at $20 to $50 a pound for $8 or less per pound themselves. So when the ranch came online in the second half, the numbers tell the story. The second half revenue was 16.7 million, slightly lower than the first half of the year. But if you look at what happened to the quality of the revenue, that's the real story. Gross margins jumped from 19.7% to 41.4%. So that is a 22% percentage point improvement, half over half in the same calendar year. So gross profit went from 3.6 million to 6 million. It nearly doubled and on lower revenue. And free cash flow swung from negative 2.4 million in the first half to positive 1.3 million in the second half. That's a $3.7 million swing in 6 months. So Q4 specifically, they had 8.3 million in revenue, up 39% year over year. Gross margin hit 45.5%. So adjusted EBITDA was 1 million, free cash flow was 1.2 million positive. So this company is running on the post-farm model now, and it looks like a fundamentally different business. I'm really excited because I was right. So I'll just say that. But a quick note, the GAAP net loss in Q4 includes 10 million in non-cash charges related to the conversion of the debentures to equity. So that's a balance sheet strengthening activity, not a cash event and not reflective of operations, but it's really important that everybody understands what that actually is. For 2026, they're focusing on completing the farm. That's adding roughly 50 more acres in spring with a second tranche planned for fall. So the team has local permits in hand and a recent financing of up to $8 million led by Mindset Capital. So Micah also flagged something important for investors to track, that heading into Q2 2026, they'll be running through material grown in 2025. So the new harvest comes in late June. So there may be a transitional quarter in the numbers, and they've planned for it. So this is the kind of story that I look for in microcaps, and a clear before and after, management that's been transparent about where the business was and where it's going, and the numbers back up the narrative. So remember that LEEF is early stage and it's a high risk sector, but cannabis carries regulatory uncertainty. But the economics of what they built in Santa Barbara are real, and you can see that directly from the 2025 results. So I have a material position in LEEF Brands, and as always, this is not financial advice. Always do your own due diligence.